With the recent news about the global financial crisis and the news surrounding the transaction between UBS and Credit Suisse, the book The Zurich Axioms came to mind. In this video, I will give a summary of this book that aims to provide a practical guide for investors who wish to maximize their profits in the stock market. Written by Swiss author Max Gunther, it was originally published in 1985 and has become a classic in the world of investments. The book is based on a set of practical rules developed by Swiss bankers who operated in Zurich, known for their skill in high-risk investments. These bankers had a very different investment philosophy from the traditional approach, which focuses on detailed analysis of companies and financial fundamentals. Instead, Swiss bankers based their approach on a series of axioms that they considered more important to maximize profits. These axioms were developed over decades of experience in the financial market and were refined based on lessons learned from successes and failures. The 12 axioms presented in the book are: risk, take calculated risks. Greed, the ultimate goal is money, not emotion. Hope, when hope and fear conflict, always trust fear. Forecasts, ignore economic forecasts. Patterns, look for recurring patterns. Mobility, avoid long-term investments. Intuition, follow your intuition after due analysis. Religion, don't marry a stock. Optimism, when everyone is optimistic, it's time to sell. Stubbornness, when everyone is pessimistic, it's time to buy. Consensus, avoid consensus news. Chaos theory, chaos is an unrecognized order. Next, we will provide a summary of each of the 12 axioms presented in the book, but before we proceed, we would like to request your like and subscription to the channel. Risk, take calculated risks. The first axiom states that one must take calculated risks to gain profits in the financial market. This means that investors should seek investments that offer high returns but with controlled risk. In other words, investors should carefully evaluate the risks and benefits of each investment before making a decision. Greed, the ultimate goal is money, not emotion. The second axiom emphasizes the importance of separating emotions from investments. Investing based on emotions such as greed or fear can lead to bad decisions and financial losses. Therefore, it is important for investors to focus on the ultimate goal, which is to make money, and set emotions aside. Hope, when hope and fear are in conflict, always trust fear. This axiom emphasizes that investors should always trust fear when emotions are in conflict. This means that when the market is falling and investors are afraid of losing money, it is better to follow this intuition and avoid high-risk investments. Hope, on the other hand, can lead to irrational decisions and financial losses. Forecasts, ignore economic forecasts. The fourth axiom states that investors should ignore economic forecasts. The financial market is unpredictable and economic forecasts are often incorrect. Instead of relying on forecasts, investors should carefully analyze each investment and make informed decisions. Patterns, look for recurring patterns. The fifth axiom emphasizes the importance of looking for recurring patterns in the financial market. Often, market behavior follows patterns and trends that can be identified and utilized by investors. Therefore, it is important to observe the market carefully and look for patterns that can be used to gain profits. Mobility, avoid long-term investments. The sixth axiom states that investors should avoid long-term investments. Long-term investments can be risky, as the financial market is unpredictable and can change quickly. Instead, investors should seek short-term investments that offer a quick return with controlled risk. Intuition, follow your intuition after due analysis process. The seventh axiom emphasizes the importance of intuition in investments. However, this intuition should be based on a careful analysis process. Before making an investment decision, investors should carefully evaluate the risks and benefits and seek information that can help them make the best decision. Intuition can be useful, but should be used as a complement to careful analysis. Religion, believe in religion only in matters unrelated to investments. The eighth axiom emphasizes that religion should not have any influence on investment decision-making. Investing based on religious beliefs can lead to irrational decisions and financial losses. Therefore, it is important for investors to focus only on financial factors and set aside their personal beliefs. Optimism, accept mathematics, not blind optimism. The ninth axiom states that investors should accept mathematics, not blind optimism. This means that investors should evaluate each investment based on facts and numbers, rather than relying solely on optimism. Investing based on optimism can lead to irrational decisions and financial losses. Consensus, avoid popular consensus. The 10th axiom emphasizes the importance of avoiding popular consensus in investments. Investing based on popular opinions can lead to irrational decisions and financial losses. Therefore, it is important for investors to carefully evaluate each investment and make their own decisions, regardless of what the majority of people are doing. Stubbornness. Avoid stubbornness and inertia. The 11th axiom states that investors should avoid stubbornness and inertia in investments. Investing based on stubbornness can lead to irrational decisions and financial losses. Therefore, it is important for investors to be open to changes and carefully evaluate each investment based on facts and numbers. Planning. Plan your trade and trade your plan. The last axiom emphasizes the importance of carefully planning each investment. Investors should carefully evaluate the risks and benefits of each investment and create a solid trading plan before investing. Additionally, it's important for investors to carefully follow this trading plan and avoid irrational or impulsive decisions. Each axiom is explained in detail in the book and is accompanied by real-life examples of how it was applied in practice by Swiss bankers. The book is a useful read for investors who wish to maximize their profits in the stock market, but it's important to note that the axioms presented are not a magic formula for investment success. It's necessary to evaluate each situation individually and make decisions based on solid and grounded analysis, as well as understand that the financial market is volatile and can be influenced by various external factors. In addition to the axioms, the book also presents other important lessons for investors, such as the importance of maintaining discipline and emotional control, avoiding investing based on unverified information, always being aware of market trends, and maintaining a realistic attitude towards investments. Another interesting aspect of the book is its relaxed and accessible approach. Gunther uses real examples and simple language to convey his ideas, making the reading easy and enjoyable. It's worth noting that although the Zurich Axioms is a book aimed at investors, the ideas presented can be applied in various areas of life, such as in business decision-making, personal financial planning, and risk management. In summary, the Zurich Axioms is a practical and interesting book for investors who want to improve their investment approach and maximize their profits.